Thank you for joining us, and welcome to the Lazard Insights. Our presentation today features Robert Horton, research analyst on Lazard's Developing Markets Equity team. Please note the information and opinions discussed today do not constitute investment advice. Any securities mentioned are not necessarily held by Lazard Asset Management and should not be considered a recommendation or solicitation to buy or sell those securities. All opinions expressed are subject to change. With that, I'll turn it over to you, Robert.
Today we'll discuss the exciting evolution of emerging markets from old industry to new. We'll start by exploring how the internet and e-commerce has changed the makeup of emerging markets economies. We'll then look at technology's impact on the daily life in emerging markets in a few vital areas, including shopping, banking, education, and entertainment. First, we want to highlight that the emerging markets of today looks very different than the emerging markets of yesterday. Prior to MSCI's restructuring sector weightings toward the end of 2018, information technology had grown to represent almost 30% of the MSCI Emerging Markets Index, up from only 2% in 1995. Subsequently, the sector was split into two segments: communication services, containing the internet businesses, and information technology, containing the semiconductor, software, and hardware businesses. In contrast, traditional industries such as telecom services, utilities, and materials have fallen substantially. Materials, for example, accounts for about 7% of the index, which is down from nearly 20% in 1995. So why has this change been so drastic? The birth of the internet is a good starting point. With the introduction of the internet came the development of new industries like e-commerce, online search portals, and online games. While this all initially occurred on PCs, it was not until the introduction of smartphones and further development in mobile internet technology, from 2G in 1995 to 5G expected in 2020, that growth really accelerated. I'll use China as an example of how things are changing, but the reality is that much of what I talk about is happening around the globe, in India, in Brazil, or in Russia, each at different stages of advancement. In this case, Chinese consumer behavior has been migrating from offline to online over recent years. With the widespread use of mobile phones, revenues from mobile apps have increased on a large scale. China has the world's largest e-commerce market and has become part of a key part of China's shift from investment-driven growth model to a consumption-driven one. The growth of e-commerce has been aided by greater mobile phone adoption or penetration, and we expect many emerging markets to mirror this growth path. On this slide, you can see that the internet user level on mobile phones in China grew from 500 million users in 2013 to almost 800 million users in 2018, according to Morgan Stanley, with mobile internet user penetration reaching 98% of internet users in 2018. Though the consumer internet segment remains key to and at the core of China's internet platform companies, mobile internet user growth has slowed. These companies are investing in new initiatives to boost user engagement and time spent on devices. Content and new technologies, such as artificial intelligence or automation, are expected to drive this stage of the internet in the future. E-commerce competitors in the space are targeting rural China for their expansion plans. Lower-tier cities in China are expected to drive long-term growth in the e-commerce sector due to their 1. Expanding population, 2. Continued e-commerce penetration, and 3. Growing household income and willingness to spend. Consumption in lower-tier cities is expected to triple, from $2.3 trillion in 2017 to almost $7 trillion in 2030, contributing to 2/3 of the rise in national consumption. Additionally, lower-tier cities have a similar level of internet usage for consumption and entertainment as Tier 1 and Tier 2 cities, and they tend to have a higher reliance on online media as their main entertainment compared to larger cities. The proliferation of digital service platforms, such as mobile payment, online hailing, and food ordering, has helped narrow the gap of consumption experience in both goods and services between small and large cities. The payment system, the system that supports every financial transaction, represents a huge opportunity. As you can see in this chart, fintech growth is not restricted to the developed world. Venture capital funding continues to grow fast in Asia, 265% year-over-year growth, and that excludes one of the largest financial companies in the world, Ant Financial. We think one interesting example of the digital payments revolution is India. The Indian government is actively favoring electronic payments over cash in an effort to modernize the economy and improve tax collection. Alibaba has acquired a share of Paytm, the nation's leading digital payment system. Digital payments made with funds deposited in an app and paid out through QR codes supplied to merchants bypassed both brick-and-mortar banks and plastic credit cards. Alibaba developed the system in its early days at the turn of the century when the still tiny Chinese middle class lacked access to either banks or credit cards, and integrity of the Alipay brand and the Alipay app's ease of use powered the parent company's growth into a financial colossus. The competition for a share of payments processing in India's billion-plus consumer market is wide open, given limited entrenched infrastructure. Brazil, on the other hand, does have a large credit and debit card infrastructure in place, creating different challenges for new entrants. Disruption of a concentrated industry might be more challenging, but not insurmountable, as incumbents try to maintain the status quo. Education consumption has also been playing an increasingly important part in China's household consumption. The size of China's education market is estimated at 2.7 trillion renminbi, and the size of its private education market is expected to surpass 3.4 trillion RMB by 2020, according to Deloitte. Competition has picked up, with many pure online players entering the space. New online learning models are generally less capital intensive, more flexible, and more scalable versus conventional offline models. For example, within mobile homework-based category, companies have promoted a freemium model, attracting a large user base, granting access to its homework question and answer bank, and then converting existing users into paid students in their online live, as opposed to pre-recorded, class courses. These companies are capturing student study and behavioral data. Approximately 70% of China's K-12 student accounts come from lower tier, in other words, tier 3 through 5 cities. Many businesses that previously focused on tiers 1 and 2 have started to penetrate lower tier cities through their online platforms. And many of the pure online players have started their businesses in lower tier cities. For example, TAL Education Group's online business is made up of two segments, one focusing on tier 1 and 2 cities and one on tiers 3 through 5. And New Oriental Education has CoolLearn, its comprehensive online education platform covering preschool, K through 12, and college education. As the education industry has evolved, many traditionally offline companies have transitioned to online, data-driven technology service companies. China's education market will only continue to be transformed by the introduction of new technologies like artificial intelligence, AI. AI has the capability of delivering students a personalized learning experience at lower costs through large-scale data processing, deep analysis of user behaviors, speech recognition, and automatic assessment and algorithms that recommend the most suitable content and pedagogy. AI will also improve some of the largest issues facing the offline-online education market, such as a dearth of high-quality teachers, the expense or affordability of one-on-one classes, limited teacher interaction in a large format class, and limited flexibility in learn time and venue. One of the fastest growing segments is live streaming. Internet users in the emerging markets spend much of their free time captivated by videos streamed from both strangers and celebrities. Today, 3 out of 5 live stream viewers spend an hour or more per session, and the number of live stream users itself is staggering. Almost 60% of China's 812 million mobile internet users live stream, and that's just one of the areas in which Chinese users spend their time. More than 9 out of 10 use their devices for online messaging. 75% watch videos online. 70% shop online. Nearly 60% play online video games. And nearly 30% watch others play video games. As big as video streaming has become, video games dwarf it. Mobile online game apps generated about 3 times more revenue last year than all other apps combined. As with so many other artifacts of our high-tech era, the emerging markets, the Chinese in particular, have acted as the prime movers. The top 10 grossing iOS video games of 2018 came from 2 of China's gaming platforms, Tencent and NetEase. Finally, video games have spun off yet another billion-dollar industry. Esports, video games as a spectator sport, with a significant portion of that growth coming from emerging markets countries. With a global fan base that now exceeds 500 million, esports has attracted major consumer goods sponsors, Coca-Cola and T-Mobile among others. Tencent's popular League of Legends signed a 6-year deal with BAMTech Streaming, a Disney subsidiary, valued at $300 million in 2016. Not to be outdone, Facebook contracted with ESL, Electronic Sports League, to stream 5,500 hours of competition in the coming years. In sum, with the trends we highlighted, we think the emerging markets have emerged beyond the developed markets in some respects. Lacking an entrenched infrastructure at the outset of the data revolution, emerging markets have seized the lead in building out a technological infrastructure. Depending on the country, those build-outs are at different stages of evolution, but they are happening. Developed markets consumers, who traditionally benefited solely from emerging markets' natural resources, can now increasingly benefit from emerging markets' innovation and services. And finally, we believe global investors who once viewed the emerging markets as strictly a natural resources play should look at them as a growth asset.